Hello there. Welcome to Commodities. Let's get to the big resource-related stories we're bringing you from the BNN Bloomberg newsroom. Soybean oil futures have climbed to a 40-month high in Chicago as the conflict in Iran keeps oil markets volatile. Of course, that's crude oil markets. Prices jumped more than 3%. Crops used for biofuel have become more attractive with this increase in hydrocarbon prices. And Asia's largest oil buyers are running out of ways to offset disruptions from the war in the Persian Gulf. China and India have hitherto leaned on Russian and Iranian cargoes to keep supplies flowing, but oil held in floating storage is quickly shrinking. With traffic through the Strait of Hormuz at a virtual standstill, pressure is building on prices as refiners brace for tighter global supply. And let's see how key commodities are trading right now. You can see oil is higher. U.S. President Donald Trump says he does not want to extend a ceasefire due to expire tomorrow, and that the U.S. military is, quote, raring to go if negotiations don't succeed. He said Iran has violated the ceasefire numerous times. Vice President J.D. Vance was supposed to take off for the next round of talks in Pakistan, but has since gone back to the White House for policy meetings. It's unclear when or if he'll set off. And let's have a look now at the metals. You can see copper down because, of course, this ongoing fuel crunch threatens economic growth. Let's have a look, and if we have a look at, is that a 3 months for copper? Yeah, so you can see the price plunge for a while in late March because people were worried about economic growth. It's basically gone back to where it was when the war started on February 28th. It's very close to it. Let's have a look at aluminum, though, because aluminum has had more of a sustained rise because of a cutoff of about 9% of the world's supply that normally comes from the Gulf. One feature of this oil crunch has been a surge in physical crude prices that isn't reflected in the futures markets. And that phenomenon is continuing. There's a continuing delay in reopening the Strait of Hormuz, and that's adding to the difficulty in actually obtaining oil. Let's get more from Bloomberg macro strategist Michael Bull. Thanks very much indeed, Michael. So this has been really a phenomenon. It's taken place during the current conflict, and it's not getting any better in the physical crude market.
No, especially not in Asia. So right now what we're seeing is actual spot barrels, or what it would take to get delivery today or tomorrow, going through the roof, while actual future markets still stay pretty well contained. But obviously after this weekend, when we had no real breakthrough and we still have this uncertainty of the deadline coming Wednesday, we're again seeing pressure on the futures market and also in the option market now. Calls on oil has gone way up again the last 2 days, as we would expect when you're getting worried that there will be no continuation of the ceasefire.
There were reports of some users over the past couple of weeks paying $140 US for oil. Is that the kind of price still obtaining?
Yeah, we heard even more. We saw places like Sri Lanka and Bangladesh really struggling to acquire barrels. So it's been all over the place. And again, it's about kind of the relationships you have. So we see places like China that have deeper relationships being able to source barrels more easily, but smaller countries, especially in Southeast Asia, having more difficulty. So I guess your guess is as good as mine. And that's how crazy things are right now as far as the actual physical market right now to get it today or tomorrow.
It's an interesting point that India is apparently having a harder time or faces a worse oil squeeze than China, partly because its reserves were lower.
Yes, that's absolutely right. So we don't actually see too clearly what China's reserves were, but over the last year and a half, we were constantly seeing reports where China was dip buying or in and building their stockpiles, not necessarily because they saw this coming, but just as a precautionary measure they already had underway. So they went into this in a lot better place. And India also has a little bit more of a fossil fuel concentration, especially in diesel. So they're more at the whims here of their economic activity, relying on the price of oil versus China, as we know, has had a bigger renewable push and has a more nuclear program.
Yeah, that's interesting. And of course, China far ahead in electric vehicles and things like that. Yeah. Your reporting indicates that just hundreds of ships stuck in the broader Gulf region.
Yeah, it's wild. The number right now I think is around 800, and look, 13 million barrels are locked in, and that's obviously the Saudi Arabia's being able to get some out. There's been some reworks, but we still have about 13 million barrels a day out of 100 million missing. So what we need to see is about 5 or 6 ships, these large ones that can have about 1 million to 2 million get out a day, and unfortunately we're just not seeing that. The number's a little bit lower, and it's changing day to day with no consistency.
It is interesting, isn't it? Companies price their budgets, et cetera, on WTI, but it's WTI not reflecting reality right now, the much quoted futures contract.
No, and again, if you look at the curve of the futures, it's even more extreme, where we have oil going back into the 70s sort of at the end of the year, expecting a still higher price than we had going into the conflict, but clearly not the acute 100 level that we seem to be gravitating back towards now. But you're right, it absolutely is a little bit detached from the reality we're hearing from people who are in the market on today buying. Thank
you very much, Michael. I really appreciate it. That's Bloomberg macro strategist Michael Ball. Okay, the rising price of oil raising economic concerns when it comes to inflation. ATB, though, has been surveying participants in the energy industry, and that is boosting investor interest and also industry activity in Canada. More on that in a moment. The Middle East war has, of course, pushed up oil prices. That's always good for Canada's energy patch. And our guest survey has found improved sentiment in the Canadian energy sector. However, policy uncertainty remains, including questions over pipeline development. We're joined by Patrick O'Rourke, Managing Director of Institutional Equity Research at ATB Capital Markets. Patrick, great to see you as ever. Thanks for joining us.
Thanks for having me. And Andy, let me just say, I think this will probably be our last time doing this together. I think our first time was 2015.
Oh, my gosh.
Congratulations.
Thank
you. Sad to see you go.
Patrick, that's very kind of you. Yeah, Thursday of next week is my last day. I really appreciate it. Tell us about this survey. Who do you talk to in it? Whose views are you gauging, please?
So the survey goes out to 3 distinct groups, the first being upstream oil and gas producers, the second being energy service companies, and the third being institutional capital providers, investors.
Right. Tell us about the producers. What was the main message from them? Of course, they're welcoming these higher prices.
Yeah, I think that generally across the board, the sentiment was more positive than we've seen since spring of 2024. So things were a bit on the upswing. Price forecasts have moved up off the bottom where they had been. Producers are generally looking at a positive environment relative to what they would have been expecting in the fall of 2025. I think the same for the energy service companies, and for the investors, this was the highest sentiment that we saw since spring of 2024. Now, I would say that the period of measurement for the survey was about mid-March to April 1st.
Oh, okay.
And as I'm sure everybody was aware, there was a lot of volatility in the oil markets through that time frame.
What was the general conclusion from the producers as to whether they'll be investing more? Are they stepping up their capex plans?
I think it was a little bit bifurcated between the larger and the smaller producers. I think the smaller producers, what we took away was that they're going to pay down some debt here if they have any incremental cash flow from the price strength that we've seen. M&A also looked very attractive to them. But across the board, large and small producers, growth will be in focus at some point here in 2026.
What about the oil services companies? I noticed comments within the survey that made it hard for me to work out. Is there surplus in the oil services stocks, providers in Western Canada?
The market is actually, and Tim Monticello, who's runs Point on this survey, he's a very talented member of our team, covers the energy service companies, would probably tell you that the excess capacity in the service industry in Canada is actually fairly tight right now.
Okay. Right. So obviously those stocks can be volatile. Maybe we could have a look at Trican or Precision Drilling. They're famously volatile, aren't they? When they can put up prices, they do, like any industry. And they have big expenditures themselves, the oil service stocks.
Yeah, I think that was one of the takeaways, is that the energy service companies themselves in the survey believe that they have some pricing power here. I cover the upstream companies, and they may potentially disagree with that, but we'll have to see how that shakes out in the second half of the year.
It's always a fascinating face-off there between the two. They're frenemies, I guess you could say. One point of concern was, though, growing. That's interesting. Trican down over the past while. One growing point of concern, though, is egress. Will Canada start running out of pipeline capacity again?
Yeah, and we look at it fundamentally. There are pipeline initiatives in the hopper here. We've got the Enbridge mainline expansions. We've got potential TMX expansion. What South Bow is potentially doing with Bridger. I think the question mark really becomes around the West Coast pipeline and the MOU. We haven't really seen an update on that recently, so we're all sort of waiting to see where that goes. I know there's an article saying today that the federal government prefers a southern BC route. I think that producers would largely prefer a northern BC route, just the strategic value of a deep water port. But that is a key concern. And you look at the survey, federal policy and regulation has very consistently ranked at the top of investor, energy service company, and upstream producer concerns.
Right. And generally, regulation, I mean, the Prime Minister's, Mr. Carney's government has said they're reducing duplication of approvals, et cetera, but still bureaucratic overhang and delays in approving projects is a concern.
I mean, they've said a lot of good things. We haven't necessarily seen them in action yet. And I think that's the takeaway, is that people want to see the proof will be in the pudding. Right.
What about exports to the United States? Did that come up as an issue? Obviously, we're sending, more than 4 million barrels a day, or pretty close to that, south of the border. Was that a topic that was in the report?
What they call Keystone, so the South Bow Initiative. We don't know what it'll ultimately be called if it moves forward. But that was seen as one of the most favorable potential outcomes for the industry across the board. By and large, moving barrels from north to south is not a huge concern for producers. But I think that, the entire industry at some point would like to see some optionality to move more barrels east to west, or even west to east.
Just to diversify. And then finally, LNG Canada. The industry is excited about that, and a possible final investment decision on at least one other LNG project.
So West Coast LNG is seen as one of the greatest opportunities in the survey. That's been fairly consistent. LNG Canada Phase 1, even though it had its trials and tribulations with startup, seems to be, at least from our analysis, running fairly well. We haven't necessarily seen that resonate in the Canadian natural gas markets. I think there's some nuance behind there with some of the things that are happening in some of our other export markets, specifically the Pacific markets. But LNG Canada, I think most people are fairly optimistic on that. Cedar LNG, potentially the Ksi Lisims project. So, LNG and putting that into the Asian Pacific Basin is one of our greatest opportunities right now.
That's interesting that Ksi Lisims won, backed by the Niska Nation. But I didn't know this. I'd forgotten that Blackstone is one of the backers of that one. Patrick, thanks very much. And thanks again for your kind words. Really appreciate it.
No problem. Thank you, Andy.
Patrick O'Rourke, Managing Director of Institutional Equity Research at ATB Capital Markets. Coming up, the conflict in the Middle East has distorted energy markets. We're going to zero in on the effect on metals and look at some opportunities in steel and aluminum. We'll be right back. Our next guest is optimistic about the steel and aluminum sectors and has a few stock recommendations for you. Let's get more from Timna Tanners, Managing Director of Equity Research at Wells Fargo. Timna, great to see you, and thanks very much indeed for joining us.
Yeah, thanks for having me.
Start off with aluminum, if you would. Maybe we'll put up a 3-month price. Aluminum holding on to gains. It's good, presumably, for U.S. producers such as Alcoa.
So the U.S. aluminum industry has been already benefiting from a number of factors that were more policy oriented. So, of course, Section 232 went to 50% in the middle of last year from 25%, start of the Trump administration, 10% previously. So much higher aluminum prices because of the Midwest premium as a result of those tariffs. In the last couple of years, there's been a 10% subsidy for U.S. production. That particularly helps Century, which is half U.S., as Alcoa only has about 10% of its production in the U.S. And then on top of that, layer in the Iran war, which of course has impacted several Middle Eastern producers. Middle East is 9% of all aluminum production. Right now, we estimate about 3% of global aluminum supply is disrupted and probably not coming back online foreseeably until the rest of the year, if not beyond.
Sorry, the Gulf is about 9%, but you said only about 3% of production has been disrupted?
Well, there's 9% of that, about 7% is vulnerable. So 7% total. Some of the production actually has its own alumina. The problem really comes down to the alumina availability, right? So to make aluminum, you need alumina that is imported through the Strait of Hormuz in a normal environment. There's also been disruption to LNG supplies. So far, we know of several smelters that are offline. Several of them got hit directly by missile strikes, and others were unable to produce because of available materials. The longer this strait disruption continues, the more risk that actually up to 7% of global supply is offline.
And you mentioned this one, I think Century Aluminum, you think is a pretty good play on the metal right now.
Well, it's the one that's the most exposed to the U.S. So when we think about the Section 232 impact, they have about half U.S. production. Whereas, again, Alcoa has less than 10%. Much of Alcoa's North America production is in Canada, where they have to pay the tariff, but it's more than offset by the regional premium increase.
Let's get to steel. Nucor is one of your favorite stocks there. Where does Nucor produce? What do you think the attraction is of the shares?
Sure. So part of the appeal of the steel industry in the U.S. is the fact that the imports have fallen sharply as a function of 50% tariffs. Right? It's hard to make those work. In addition to quite a bit of friction from higher freight costs, higher insurance costs, higher storage and interest costs, all of those are reducing the appetite for import for most steel products. So as steel imports have fallen off, the U.S. historically has been the single largest importing country for steel in the world. So those imports have fallen in some cases by at least half. The domestic mills are able to pick up share. So that's improving their volume story. Underlying demand is a little bit better. That's coming from largely a couple of key end markets, data centers, utility structures, and then the border fence. So those are three areas where Nucor actually has quite a bit of exposure, and they're disproportionately benefiting.
That's interesting. Yeah, I'd forgotten that Alcoa had so much production in Canada. I think they've got 3 smelters. Yeah, I always think, oh, they're American, but it's not. It's rarely that simple. What are your thoughts on copper? Do you like the prospects for the copper industry right now?
Sure. We just did a deep dive into copper. In the very short term, copper has been quite disrupted by a number of factors. So we cover Freeport, and the Grasberg mine, of course, had a mud rush incident a year ago. They are restarting and should be back online by the end of the year, but that's been a disruption to copper supply. In addition, the Panamanian supply that was offline looks like it could restart as early as next year. So some of the big supply disruptions that caused a squeeze in the near term look to be rolling off. Plus, there's pretty high inventory levels globally. So copper is a bit tricky right now. We'd rather be selective, with Freeport being our top pick. And keeping in mind also there's some noise around diesel availability right now in some of the key mining areas, and sulfuric acid. But for the most part, if you take away some of that noise, there's actually, I think, plenty of copper for the next year and beyond, as high prices are often the cure for high prices.
Thank you very much, Tim. That's great to talk to you. I think it's been ages. I really appreciate it.
Thanks again.
Tim Tanner's Managing Director of Equity Research at Wells Fargo. Okay, let's conclude on nuclear. Canada's only nuke plant outside Ontario is critical to New Brunswick's energy supply. It provides normally between 30 and 40% of the province's power when it's operating. But on April 10th, the station went offline for a planned 119-day maintenance shutdown. CTV's Laura Brown has more.
At 43 years old, Canada's only nuclear power plant outside of Ontario is critical to New Brunswick's energy supply. But it hasn't always been dependable. Last week, Point Lepreau Nuclear Generating Station went offline for a planned 119-day maintenance shutdown. Last year, it was offline for 160 days.
This is our only planned outage this year that we're in now. When we look to our regulatory filing, we do have a short planned maintenance outage in 2027 as well.
New Brunswick's power utility allowed cameras in for a rare look inside the nuclear station before it was shut down. The plant has a tumultuous history of outages. When it's on, it provides 30 to 40% of New Brunswick's power needs. When it's off, it costs about $1 million a day to source that power elsewhere.
We are building on time and we are building on budget.
This month, Ontario, with its nuclear expertise, has started to lend a hand. Nuclear engineers from that province are now on the ground at Lepreau, an agreement worth $25 million a year. The hope is to get the plant operating more consistently.
The investments we're doing right now, they did that years ago. So they're reaping the rewards now. So I'm just hoping, I'm confident that we're going to see some of those results.
New Brunswick's energy minister maintains Lepreau is an incredibly important asset, and he believes despite its problems, it could expand.
We have a federal government that has clearly indicated that they want to have new nuclear outside of Ontario before 2035. We're the most ready jurisdiction to have that.
This current shutdown will also give engineers a chance to see if they could harvest isotopes at Lepreau as early as next year. Laura Brown, CTV News, Fredericton.
Before we go, let's have a look at a few commodity stocks of interest. The rise in oil prices today, lifting some hydrocarbon-related names. Methanex, MX, posting a decent gain, up around 4%. Last time I checked, methanol prices tend to rise and fall with oil. So MX, one of the gainers in Toronto. And also, thank you, Control Room, and also Superior Plus. Now, this stock, SPB, has been out of favor, largely because of troubles at its U.S. renewable natural gas operation. However, that one is on the point of winning, if it hasn't already won, a contract to supply a big data center. And so investors happy about that. Good news for the U.S. units. Taurus and Athabasca Oil, another gainer, ATH, up around 3%. Among the losers today in Canada, the gold stocks. We have seen gold slipping because of strength in the US dollar. Thanks for watching Commodities.